So you want to know what's happening in the Texas retail real estate market? Well, we've got you covered. We just got back from ICSC Red River 2025, and we're here to share some of the highlights and key takeaways you need to know. Welcome to RESOLUT REveal, the podcast by RESOLUT RE, where we reveal market insights, advisory, and opportunities in commercial real estate. I'm Ray Kang here with David Simmonds and Martin Turner, and in this episode, we're breaking down our experiences from ICSC Red River 2025, sharing key takeaways and what retailers, landlords, and investors need to know to stay ahead. But before we dive in, let's kick things off with a quick market update on DFW retail, what's trending, and what we are seeing in the market right now. DFW continues to lead the country in retail performance with historically low vacancy rates at just 4.6% and consistent leasing activity driving demand. Over the past 12 months, DFW saw 2.3 million square feet of net absorption, outpacing almost every other metro in the U.S. Developers are staying ahead of demand, delivering over 3.2 million square feet of new retail space this past year, one of the highest levels in the past decade. Collin and Denton counties are seeing the most growth, reflecting their population surges and economic expansion. What's impressive is that 65% of these new projects are pre-leased before completion, underscoring strong demand even before doors open. Rents have been climbing for 11 straight quarters with an annual increase of 4.3% year over year, one of the strongest rent growth rates in the country. Despite some new supply entering the market, retail vacancies remain near record lows, keeping rents elevated. Investor interest in DFW retail remains high, but sales volume has dipped to $630 million in the past year, marking the lowest since 2010. This is due to higher borrowing costs, which have made institutional investors more selective, leaving private investors to dominate the space. Cap rates for multi-tenant retail have adjusted upward to 6.9%, while single-tenant net lease assets, particularly grocery-anchored properties, continue to hold strong at 5.8%. DFW's population growth continues to support retail expansion with over 153,000 new residents in the past year alone. The metro is also a magnet for corporate relocations, with companies like Goldman Sachs, Charles Schwab, and Caterpillar bringing thousands of new jobs and retail demand along with them. With 450,000 new jobs added since 2020, it's no surprise that retailers continue to target this market for growth. Dallas-Fort Worth remains one of the most resilient retail markets in the U.S. Despite interest rate challenges, demand is steady, rents are growing, and new developments are filling up before they're even completed. If you're a property owner or investor looking to expand your retail presence in DFW, RESOLUT RE has the expertise and insights to help you navigate this evolving market. To learn more, visit us at www.resolutre.com. That's RESOLUTRE.com, and reach out to our Dallas team for a deeper dive into available opportunities. We are RESOLUT RE, representing over 800 commercial properties and 300 tenants, providing exceptional service in leasing, sales, and advisory. Our clients rely on us so they can succeed. Visit us at resolutre.com. That's Resolute without the E, RE.com. For those listening and maybe unfamiliar, ICSC Red River is one of the premier conferences specifically focused on the Texas retail real estate market and part of a series of regional events hosted by ICSC. And they have a flagship national event in Las Vegas, typically held in Q2 of each year. And me personally, I think the show, being in the front part of the year in January is a great way to really kick things off. I really get, really engaged and involved in mid-December prior to Christmas, because that's where you can kind of see who's attending the show. And that's where I like to do a lot of my outreach, kind of get ahead of the game. How about you guys? How do you guys prepare for the show?
So it's funny that you say you love having it in January, because I was just talking with one of our brokers yesterday who was saying how awful it is that it's right after Christmas break, and they come back and are getting in the rhythm of brokerage and needing to set meetings in a very short window and whatnot. So I think some people maybe like it in January. Some people much preferred it in November when it was then.
Yeah, Ray, you're the only one I've ever heard say that.
Okay.
And I've heard a lot the other direction. Exactly what Martin said. I mean, it doesn't seem like anybody is tuned into that in December, especially retailers.
Mm-hmm.
And then you have that short period of time. They've now pushed it. I mean, it used to be like, January 15th? It used to be ridiculously early. So at least they pushed it back to the 28th.
For sure. Yeah, I think for me, because I love the holidays. Of course, it's about family and spending time and quality time with, people you love. Yet right after Thanksgiving, it feels like the market just slowly starts to tune out, right? And it's hard to get things done. And it really bothers me a lot. But at least, because I have a target for ICSC and it keeps me engaged. And I kind of force people to stay engaged as well because I'm asking for meetings and calling them up, et cetera. So, yeah. That's for me. I guess I'm the oddball.
Ray doesn't like holidays.
That's the take from this.
Martin, unfortunately, you weren't able to attend this year. So I figured that there's probably a lot of things that you're probably curious about and some questions that you want to check in with us.
Yeah, well, I guess let's start with the macro. What are sort of the trends and insights that you guys came away with?
Retailers and restaurants, not true retailers, although some, they're active. They're looking to do deals in Texas and the Dallas market overall. It's amazing, just how big it is and yet how tight it is. It's got the size like a Houston, then it's got the tightness like an Austin. And there's development happening. I mean, nothing on the scale before COVID and Amazon, but they're putting down 15, 20,000 square foot strip centers, which is not enormous, but they're getting immediately LOIs to lease the whole thing 150%. You can get in as early as you want, and you're competing. And so there's some new players on the market, development-wise, and certainly the veterans. But overall, it had a very positive feel as far as, people are open for business. They want to expand.
Yeah, I got a lot of that myself. I think everybody coming to the show, especially here in Texas, everyone seems very bullish. I think there's a little bit of cautious optimism. There's a lot of great things happening in the U.S. economy overall, but then there's a lot of confusing information and contradicting things in the market as well. We're still seeing a lot of investors and business owners having a little difficulty making really hard decisions. I think if we put things on a scale of 1 to 10, as compared to last year, I think last year was a 7. I mean, it was pretty hard, especially in the investment sales area. But, coming into this year, a lot of the conversations and people I've met, and that was from investors to operators and retailers and then to mortgage lenders, it was kind of, I think, incrementally better than last year. Not like a full 8, from a 7, maybe, a mid to high 7. And I just think that people, again, have that cautious optimism. Last year, the slogan was survive until 25. And I just think people are just kind of happy that they made it to where we are right now. And then there's still a lot of questions, lingering in the air. But, as for retail, like David mentioned, and we kind of touched on in our market report earlier, especially in the DFW area, a lot of the stuff coming out of ground is already pre-leased. There's still really strong demand and, just a lot of short supply and, frankly, not enough coming online this year as well. So I think that's just going to continue.
I do a lot of national tenant rep, and it's like this all across the country. Akron, Ohio, Omaha, Nebraska. I mean, it's just Nashville. I mean, it makes Austin look loose. It's amazing. The only thing I can think of, because I haven't read any articles about it, is that, it started with the Amazon effect. These developers pulled back 2017, 2018, and then COVID hit and they pulled back more. So the supply is just not there anywhere in the country. It looks like I'm getting a quick deal done in southern Boise, which is a pleasant surprise. But no, everywhere it's just it's not even just Texas. It's just tight. There's no supply. The number of times I've heard a local market broker say to a client in the introductory call that we're at a 2 to 3% vacancy rate. It's every call. It's every market.
So were there any like standout conversations that you guys had with retailers or property owners that you would want to share?
Property owners, more on the development side, they're being really inquisitive about rates because of the land prices being so high, because construction prices are still through the roof, and amazingly so increasing. It's all about the pro forma. So it's sort of like that's the first, the middle, and the last question when I'm meeting with these guys.
A lot of the existing owners and investors out there still wanting to find product in Texas. I think there's a lot of fatigue in trying to find and source deals. The existing owners are very happy with their portfolios right now, as again, vacancies are at historic lows. Rents are healthy. All the tenants are performing really well, but they're having a really difficult time in finding deals. And the deals I mean are the ones that they're used to, meaning the deals that really pencil out well for them. There's no shortage of capital out there to be placed, yet the debt component, higher interest rates, continuing on financing, and it's a seller's market right now, right? There's not a lot of supply out there on market, so sellers are still able to ask and command a lot of price, but the buyers aren't interested, right? And the capital is a lot more patient than it was before. So I think we're still going to continue to see this pricing discovery throughout 2025, and where that's going to land and how long that's going to take is going to be the big question. But it's a little frustrating for most. I've seen a lot of syndicators choosing different options and looking into different markets as well. They're really casting a much wider net throughout the country looking for deals. And a lot of these guys, because they have the capital available, they're doing a lot of hard money lending as well. Short term, because they could be a lot more competitive with traditional financing and the other available capital that's out there as well. So there's a lot of creative things that they're doing right now because they just can't find the deals.
So what do you think the big opportunities in the market are right now?
Those who really want it are beating out their competitors as far as acquiring product and building product. Sort of Ray said, there's fatigue, and that's putting a lot of players on the sideline. They're just going to wait it out or find something else to do. It sounds kind of, I don't know, almost corny to say it like that, but the people that are, really hustling, determined, they are finding deals. They just may not be the best deals, but the rents continue to rise, which is just amazing to me. Unanchored neighborhood shopping centers with local and regional tenants being in the $35 to $40 range. The Academy in Georgetown, Endeavor's now doing the rest of it. They bought that, and they're getting $55 a square foot. It's just, it's mind blowing.
And triple nets on top.
Plus $20 triple nets, I was going to say, yeah.
Yeah, it's Williamson counties. You ask yourself, how are these businesses going to stay in business? So
I think like for this year too, that's going to be a reckoning with the tenant tolerance to the prices as well, right? I think there's going to be at some point really hard conversations, especially when it comes to renewals. And there's probably going to be a lot of renewals coming up. And landlords are going to try to take advantage of the supply and demand market. I've actually had a few conversations with institutional investors and private, because they're really rubbing their hands, knowing that there's a lot of renewals coming up in their rent rolls, and they're going to see how far they can push it.
So did you notice any trends within the retailers at the show? Like, are there specific categories that just seem to be on the expansion front versus the categories that are kind of drawing back? What were your takeaways there?
The 3 F's, food, fun, fitness, that pretty much sums it up right there. A lot more franchise concepts versus corporate than in the past. There's never a shortage these days, there's never a shortage of supply with those 3 categories.
I've noticed a lot of newer, like fitness, not a lot, but some newer fitness concepts. But it feels like they're updating the amenities to get to the new generation of people that want to make it more experiential. And you see the ice bath thing, you see a lot more pickleball, the saunas, much more amenities inside the physical fitness footprint. And to go back to restaurants, I talked with a lot of franchisors over the last 6 months too. And what I'm noticing is that they're really figuring out ways to save a lot of money on operations, meaning scaling down the labor, scaling down the size of the menus and things that can kind of overlap so that they could just make things easier so that the cost on the franchisee is much lower. But, with inflation and also with labor costs and then real estate costs, it seems like, they're positioning yourselves for success, but not necessarily on the experience itself, but in the back end of ways to save money in operations.
So on the flip side of that, what categories did you see or not see there with aggressive expansion plans, and what categories were drawing back?
The ones that have been drawing back for a while, soft goods. Now there were discount soft goods as far as the ones that like the lower price offerings for their lower income consumers in smaller towns become big fish, small pond. Some of them are still there. It's just, I remember when I went to a retail live and Gap was there. That's not happening anymore.
Yeah, that's a great point. When I went to walk the floor, especially down Retailers Row, you see a lot more lesser known brands and smaller operations, but on heavy expansion mode yet. Yeah, I didn't really see like a lot of the majors that we used to see.
So yeah, let's talk about that a little bit. So at ICSC, you have, the first day is typically heavy on meetings from start to finish, and then you have the retailer roundup that second day where everybody walks around, talks to the retailers. And of course, you still do have scheduled meetings that day, but it tends to be a much lighter day on that. What did you guys find to be the most productive out of this year's ICSC? Did you feel like you got a lot from your meetings versus the roundup versus just sort of impromptu meetings in the hallway? Where'd you guys find the most value?
I would say the retailer roundup. And now they have it both days. We're at Retailer Row now, where it's open both days now. So Thursday is the day. Friday is a ghost town. So, and yeah, that Retailer Row, it's a great concept. You're just bouncing, and just one concept after another. Lines aren't that bad. That's sort of good news, bad news as far as attendance, which is still trending downward. But, meetings, right? I mean, be cliche. You get out of it what you put into it, as far as being strategic, as far as making those cold calls, to get them set up. And then the impromptus. I mean, that's what makes those conventions unique, or those impromptus.
Yeah, for sure. I love going to ICSC shows. It's, the networking and, of course, like actually getting to meet your customers that you've been talking to on the phone for many, many years. But having that face-to-face, I think, is so important, especially in our business. But, I think if you're really intentional with your time, like David mentioned, what you put in, you're going to get out of it. I think there's a lot of value there. I mean, in reality, it's not like you're transacting and making deals happen at the show, but there's a lot of routes that you're planning, and that always leads to something. I mean, I've been going to show for many, many years, and I see a lot of the fruit being harvested now from a lot of the relationships that you've built over the years. So, that's, for me, beyond not so much the impromptu thing. And actually, like, I'm too tired to hang out too late at night anyway. So it's just early mornings. I fill my schedule, in particular Thursday, the second day, the longest day, and just try to get the most out of it then. But it's the best way to, like, you could read research reports, you could read macroeconomic news and all this that's happening in commercial real estate, but you learn so much on the ground with people that are actually in the business by having conversations with them. And that you're not going to get there from anything else. I really try to learn as much as I can what people are excited about, what they're seeing in the market, what their sentiment is about everything. You get really good comps as well, what kind of financing deals they've got done, what new tenant they got in or whatnot. So it's, I think it's really valuable information. And then you're able to, give back too. So from other conversations that you've had, you're sharing that information with them. And it's, there's a lot of value to be made there.
And to go back a couple of slides, something that Ray said was really interesting as far as these fitness concepts setting themselves apart with, more amenities, different amenities. I haven't confirmed this, but I've heard that Orange Theory is on the decline, and not just a bit either. And so, it's interesting because they haven't evolved. I mean, it's just, you go in there, sometimes they pack you in there like, sardines, and, you work out, right? The programs are good. The instructors are good. The overall philosophy is great, but it's not keeping up. And, these other concepts are, probably coming in and undercutting them, because it's plain Jane,
How was the attendance this year versus prior years? Did you notice any significant difference?
It felt down, every year's, feeling more and more down. Yeah. So I haven't, gotten out the bar graph or anything as far as what those numbers actually look like. Maybe it's just a sense of pessimism that has set in, but it felt down again. All the booths are decreasing in size. Maybe there's one or two, but I mean, and these are major players, including us. So the booths are scaling back, and the attendance seems down.
So that was overall sentiment with the majority of the people that I spoke with. I mean, you do notice the booths getting a bit smaller. And I think next year they're not going to have it at that convention center as well, from what I'm hearing.
That is correct.
But I have a relationship with ICSC. I was their inaugural content creator group last year, and I've always stayed in touch with them. And we're also trying to work on having an ICSC local for Central Texas. So I'll keep you updated on that. But I asked them, well, how was turnout? So I don't think we've ever got back to where we were prior COVID yet. They told me, last year they had about 3,800 people attend, and this year they were at 4,200, like a 10% increase. So there's a bit bigger turnout, yet I think just like overall sentiment is not very as excited as it used to be about the show, which is interesting.
And last year was just bad, I think. I don't know what their year-over-year last year was, but it was probably down 20% or so. So they had some room to climb there. So did either of you notice any trends with respect to the size of space that retailers were taking and changes in their search criteria?
Yes, it's nothing new though, because the space sizes keep going down. I touched on it earlier as far as menus being decreased, size being decreased. One, for operation costs, but two, just overall costs. Growing up in the business, I was always told, you don't want rent being any more than 7-8% of overall costs. And if you did, you're done. I'm seeing that a lot higher these days, sometimes as much as double. It's the same complaint that I touched on earlier. We need more space. And, some of my clients will pay those numbers. Just get them a space that works, there's not space in areas that don't work. It's just, it's really incredible. Now, look, when I got in the business in 1997, Roger Anderson of then the Vanguard company, and and then UCR, and got bought out by CBRE. Anyway, he was my boss in 97. He was saying in 1997, that Boston didn't have enough space. But this seems really acute to me. It's amazing.
Yeah. What about broker sentiment? We talk to brokers every day, but you're in a room and probably half that room was brokers there. What did you feel the sentiment was amongst brokers?
They're very excited that the election's done. A lot of them are very excited about Trump. And they're also just, they're overall excited about, the market and the economy. So I would say on the whole, very bullish.
Yeah, I agree with that. A lot of us calling and talking to our customers, at the end of last year was, oh, let's wait till the election. Let's wait for, for the next administration to come in, then we'll make some decisions. But, all that has come to pass. But, the decision makers still aren't able to make hard decisions right now. So I think there's a little frustration as well. Although, we survived till 25. Now that we're here, I think there's still a lot of waiting on the fence, seeing what the clients are going to do. There's also, I've talked with a lot of leasing brokers out during the show too, and there's a lot of existing concern about the prices right now, like price per square foot. How are tenants going to be able to manage all this? Plus the, in the San Antonio market, there's the triple nets have almost, doubled in some areas too. So it's like that added cost and that's passed on to the tenants. That's been a real concern for, I think, a lot of leasing brokers. And they're just wondering, is this going to be sustainable? Is this going to be acceptable? Because they want to fill the spaces, yet there's the concern on price.
And then, something I don't think we've touched on is the construction for the tenants too, the finish outs.
Yeah.
Some of the numbers that the franchisors are telling the franchisees, they're science fiction. And so then they get to me and we have that discussion. And it's like, I just told them that the Easter Bunny wasn't real. It's like, the cost per square foot, when I came into the business, it was $35, maybe $40 to white box a space. Right. That has since doubled. And it's only getting worse. Good luck even getting a contractor in Austin to return your phone calls if they don't know who you are. They've got more money. Well, that too, but they've got more business than they can say grace over.
David, have you seen, the types of TIs that retailers are asking? I mean, is there for like a certain user or, what their expectancy is on what they expect on something like a new lease or?
Because I'm dealing in the franchise game, 99% of the times, it really does vary. I work with a lot of emerging brands, so they don't have that sort of set, these boxes need to be checked or else your deal's not going to be approved. So, take my back nine client, which is a indoor golf simulator concept. I've got, one franchisee in Princeton, New Jersey that's taken on new construction. We're getting maybe $50 a square foot, maybe. But then I have Summerlin, Nevada, where my clients get a complete white box delivered to them. So it really varies market to market. And that's the thing that's been interesting about construction. Whereas the rents, all right, we just told the story. On construction, as far as how much landlords are willing to give, boy, it varies across the board. It really varies. And I'm seeing landlords respond almost proportionately as far as, giving the tenants more TI, more on the delivery. They understand there's only so much pain that could be, experienced. Ask me, for the time, I'll tell you how to make a watch. What are tenants expecting? I'm typically for second gen spaces, I'm putting in, $30 of, TI, and getting, somewhere between 20 and 30, again, depending on the market. And then new construction, actually not as generous, ironically, but I am getting, typically somewhere between 50 and 60.
And it seems like it's a double whammy because construction timelines have increased quite a bit as well in the last 5 to 10 years. I mean, I remember doing deals where, we were getting, $30 a foot for our white box, and we were getting 3 months time, and tenants were able to make that if they moved properly. But nobody does it in 90 days right now. That's just impossible almost.
So let's touch on that. Like, what do you think? Permitting process, supply chain? I mean,
all of the above. These contractors having more work they can shake a stick at. And then absolutely the municipalities have only gotten worse. Austin's is still terrible, but it doesn't stand out as much as it used to.
Yeah, at least in the markets that we operate the most in, all of their permitting timelines have just gone up significantly in recent years. And then, of course, you have the labor shortage from post-COVID era and labor costs and all of that. And so I think it's just that has been hit on so many different fronts.
Yeah. Interesting too. I mean, I know that the tariffs have been in the news a lot lately. Not that they're fully implemented, but I've noticed, I did a small video on Chipotle yesterday where, they've already preemptively changed up their supply chains so that they can make sure they could deliver their guacamole. So their avocado supply is coming from a lot of different regions now, because if they were highly dependent on Mexico, but I think they've shifted 40 to 60% of their sources from other regions that are not going to be affected by tariffs. Steel manufacturers have already bumped up their price, even though the tariff has not been implemented. I talked with a couple construction GCs yesterday, actually, and they were telling me, yeah, the prices have already gone up 10 to 20%. So it's going to be an interesting year. And I think that's, from our conversation today, I think that that's what we're hearing, although still positive, it seems, right?
Amazingly so, because there's the headwinds, we just talked about.
And it's so hard when you're coming out of just a sustained bull market like we've had. I mean, years and years of just like, okay, this is great. When is it going to end? Yeah. And you kind of expect to go crashing into the abyss when that ends. And that hasn't happened. A little bit on the sales side, we've certainly seen the pullback a whole lot more on that side. It's just a weird market when, you're here, and yes, it's bad compared to where we were 2 years ago, but in the grand scheme of things, it ain't that bad. It's kind of like interest rates, right? Interest rates are bad compared to where they've been, but historically speaking, they're kind of middle of the fairway, right?
Yeah. It's definitely a new par for the course, right? Yeah. In kind of touching on investment sales, I think we've seen the worst, and we're getting out of that. We were down like 70% across all sectors in transactions in early 2024. I think in late 2024 there was an uptick at about 15 to 20% in activity. Yet it is extremely low activity continuing, and a lot of the investment sales brokers are very hungry, and I was completely hungry, and it's still hard to get deals done. But when we're talking about market pricing, which is still very difficult, in trying to find pricing where it's acceptable to majority of the market, still, the challenges with the cost of capital. But we have a lot of hungry brokers over there. And, one thing that I've talked about with some others and seen firsthand is that a lot of the brokers out there, because they don't have the deal flow and not the listings, a lot of them are just going ahead and over-promising a lot to the owner. So, they're willing to take out at any price as long as they get the deal with the hope of, having the seller accepting the price upon a lot of negotiation, right? So they're taking a lot of overpriced assignments and hoping for the best. And with that activity out there too, it's going to take a lot longer in pricing discovery as well. I mean, brokers have a lot of influence in the market.
Sure, because other brokers or other owners are looking at those properties and saying, hey, that's market.
And that does it for this episode. Before we go, don't forget to subscribe to RESOLUT REveal, our podcast, to stay informed on market trends, success stories, and actionable insights in commercial real estate. Follow us on Spotify, Apple Podcasts, and you can find us on LinkedIn, YouTube, and other social media platforms. If you're ready to partner with us to maximize value on your property, find the perfect space for your business, or have any questions, don't hesitate to find us at www.resolutre.com. That's RESOLUTRE.com. This was the RESOLUT REveal podcast, where real insights lead to real results.